Okay, Rajat Bhattacharya, a senior investment strategist at Standard Chartered. He joins us now to take some questions. Rajat, good to have you with us here. Thank you very much. Let's just begin with what is new. What is new was that powerful rally we saw on both the Nasdaq and the S&P on Friday. I mean, actually, this year so far, Rajat, it's been very clear, right? Very different as compared to last year. Equities are higher. The Nasdaq is up 7% year to date. Yields are lower. The 5-year is down 50 basis points year to date. And the dollar is weaker as well. So this is a risk-on kind of a setup. Your sense overall, Rajat, in terms of how things are looking?
Yes, morning, Prashant. Yes, that's right. It is a risk-on setup, unlike what we saw last year. And that's primarily driven again by the central banks. Last year, the central banks turned hawkish end of 2021, and that we saw filter through in last year's January. This year, people are expecting the central banks to turn more dovish, as in they will slow down the pace of rate hikes. Now, that is what has driven the yields lower, the dollar lower, and stocks are slightly higher. But we should caution there. We're not so sure that the Fed, or for that matter the ECB, have done with the rate hikes yet. We see actually the Fed going another, let's say, 75 basis points higher in the next few months. So next month, on 1st February, they might hike by 25 basis points, but they'll keep going on till they see inflation month on month. That month-on-month inflation number in core inflation needs to come down. So they need to see month-on-month inflation go down to 0.1% or even flat or contracting before they stop. ECB, in fact, we have a upside risk to ECB rate hikes. Why we say that? Because in Europe, the winter has been not so harsh. In fact, it's one of the warmest winter in Europe on record. What that means is that the energy crisis that people were expecting, the tail risk, that has gone away. And as the tail risks go away, European indicators are reversing strongly. And again, set that against the core inflation, which is still rising, steadily, and it's above 6%. ECB is really worried now. So ECB rate hikes might go higher. So in the West, rates are probably going to go still higher for some more months. So we need to be cautious a bit on stocks in terms of the West. In fact, our latest call has been fade the rally in European equities. European equities have outperformed US equities. To your point, European equities have done much, much stronger, and it's time to fade the rally there.
Okay. Well, at that point is taken, but back home we're noticing some very interesting trends. We of course have the big union budget coming up. There is some talk of taxation, which of course may not go down too well with the street in terms of tweaking of the long-term capital gains tax definition, etc. But that all is just rumors at the moment. What we're also noticing is that the earnings picture is shaping up really well, especially with some of the larger private sector banks. Would you, in a market like India, increase your allocation to some of these spaces?
Hi, Sonia. Yeah, well, India, you talk about the budget, and it is time probably for some consolidation because India loses the budget to react to the COVID crisis. But in terms of the market itself, it's still richly priced because you see that when you compare with the rest of Asia. We've seen the rest of Asia outperform significantly India, and India's held its ground. So in that sense, maybe not time to add in India, but structurally it's a strong story. To your point about the economy itself, what we're seeing is the private sector, private demand for loans is picking up. That's a positive sign. India has always been a domestic demand-driven story. It's going to be more relevant. Domestic demand is going to be more relevant this year, given the slowdown we're going to see and a possible recession in the US and probably Europe this year. So India's organic growth that we see in the rising lending demand and the private sector, the confidence picking up, is positive for its future earnings and growth. So I wouldn't sell India, but I would add here, given the relative valuation that is there with the rest of Asia.
All right, Rajat, very quickly, if you could tell us expectations on crude oil. It's suddenly moving to around $88 per barrel. I recall you saying that you're expecting it to move down, and that was the big call, but unfortunately it's moving up. Quick take?
Yeah. Crude oil, I mean, it's on the longer scheme of things, it's trading within that range. It has fallen off significantly from the highs of last year. And again, a lot of that has got to do with the fading of tail risk in Europe, and also the slowdown in the West. Now, one of the drivers of crude oil, upside drivers, is obviously China's recovery, and there are evidence. There's evidence that it's recovering fast because the COVID cases in the big cities have peaked in China. So if China recovers faster than expected, there is scope for support for crude oil, but we don't see it going, significantly higher, and that is good news for India. That's one more good news for India in terms of its balance of payments.
Okay, well, thanks for stopping by and speaking with us. Have a great 2023. Of course, we'll chat with you again very soon. Well, that's the word coming in from Standard Chartered. Time for some consolidation in the Indian markets. Perhaps India is quite richly priced compared to its global peers, and it's not a good time to be adding in India. That's the summary of the conversation. Let's slip into a quick break. Our list of top 10 stocks coming up with our entire research team in just a bit. Stay tuned.